Hello everyone, my name is Chris Previty. I'm a director at Feeley Driscoll. Today we'll be going through a high-level overview of income tax returns. The goal is to get the audience more familiar with the look and feel of the different types of tax returns you may see out there. We hope you walk away from this podcast obtaining a basic knowledge and overview of different types of forms and their intent. The goal is to have you feel more comfortable reading these returns. First, before we get into the actual core forms, I'd like to review tax years. Some entities operate on a fiscal year end. The tax year in which that particular return would be completed is based on the beginning of the year. For example, if you are a September 30th, 2012 fiscal year end, you'll be completing income tax form year 2011, as the beginning of the year, October 1st, falls in 2011. Deadlines vary based on the type of return. For example, you may be familiar that all personal income tax returns, also known as the 1040, have a due date of April 15th. Corporate returns with a calendar year end of December 31st would also have a year end due date of March 15th. Depending on the type of entity, you may be required a different form of return. For example, an S corporation would be required to file a tax return known as the Form 1120S, whereas a C corporation would file a return known as the 1120. Nonprofits file a tax return known as the Form 990, and a partnership, albeit the same information that gets transposed onto the return, files a return known as the Form 1065. We will go over some examples of each of these types of returns throughout the presentation today. Here we're looking at the Form 1120S, page 1. This page gives the basic information of the client, name, address, and federal ID number, which is all blocked out in this example. Here is a high-level overview of the gross receipts and expenses for that organization. A few things to point out. If trying to compare the tax return to a set of financial statements, it may not always be cut and dry, tying one number to the next. As we will get into later in the presentation, there are different types of differences, book and tax, temporary and permanent. On this slide, you can see total revenues of $14,974,000 in line 1C. The reason I point this out is because this revenue number would be based on the tax basis on which the return is filed. Now, when looking at financial statements would be filed on an accrual basis. Depending on the type of entity, an organization may elect to file taxes under a different method, for example, on a cash basis, or for contractors, a completed contract basis. A few key items to point out on the Form 1120S that may be different from the look and feel of a basic set of financial statements are in the expense section, where we break out compensation of offices separately. Line item 19, which is your other deductions. To get the detail of this, you'll need to go to the statements in the back of a tax return. Like any set of financial statements, your revenue is reported up top, less any direct cost of goods sold, to come to a total gross profit. The middle section here are your deductions for SG&A expenses as you would see them in a set of financial statements. Certain items are broken out individually on the face, and as I mentioned on line 19, to see the detail of what's included in this number of all other expenses, you would go to the statements in the back of the tax return. The ordinary business income loss reported on line 21 usually will not tie into the financial statements. This is due to some of those temporarily and permanently tax differences, which we'll discuss a few slides from now. As an 1120S is a flow-through entity, that income is flowed through to the K1 and reported on an individual tax return. Before we discuss the 1120, I want to take a minute to discuss the term flow-through. S corporations and partnerships are known as flow-through entities in which no federal tax is paid at the corporate level. All income earned in the corporation is flowed through by the means of a Form K1 to the individual owners or shareholders of the entity. When preparing your individual 1040 personal tax return, the K1 from the corporation in a flow-through type entity is used to transport the revenue from the corporate return to your 1040 return. Here on this slide, we're looking at a Form 1120. The look and feel of this form is very similar to the Form 1120S. However, one key difference is the income on this form is taxed on the federal level, as a C corporation who files a Form 1120 is not a flow-through entity. The top half and middle sections of this form are very similar to the previous form we were just looking at. However, the one item I wanted to point out, starting on line 30 towards the bottom of this slide, is we come to a total taxable income number. As you can see, the tax is calculated on this form versus a Form 1120S where there was no tax calculated at all. The $10 million of taxable income in this example generated a total tax of $3.4 million. You then would subtract out any estimated tax payments that were made during the year to come to a total amount owed or refund due, very similar to what you would see in a 1040 return. The Schedule B, as reported in your 1120 return, which would be very similar from an 1120 and 1120S, is where you would determine the accounting method used to calculate taxable income. In this particular example, you can see that the other box is checked off. What this means is there is another method besides the cash or accrual basis used to calculate taxable income. IRC, which is Internal Revenue Code 460, is the completed contract method used by this taxpayer. All tax returns ask a series of questions that the IRS will look at to determine a particular organization is in compliance with certain rules and regulations. These questions can be scattered throughout the tax return, however typically come within the first 5 or 6 pages of a return. I'd like to point out on line 10A the question, did the corporation make any payments in 2011 that will require it to file Forms 1099? Most organizations may pay independent contractors separately from employees, in which case they would be required to issue 1099s. This question acts as a reminder for the corporation to make sure all 1099s have been filed properly by the appropriate due date. On the next side, you'll see the Schedule L. Schedule L on your Form 1120, 1065, or 1120S are all very similar. The Schedule L is your balance sheet. The balance sheet should tie into your basic set of financial statements if you're looking at both. There are some exceptions to this rule. For example, if a taxpayer is reporting its income on a cash basis, the balance sheet may be reported on a cash basis as well, where you would see no accounts receivable or accounts payable, for example. Certain entities are required to file a form known as the M3. When total assets of a particular entity exceed $10 million, a separate reconciliation is required to be completed, and this balance sheet is required to be reported on an accrual basis. On the bottom half of the balance sheet on the same page, split into 2 slides here, is the Schedule M1. This immediately follows the Schedule L. Your Schedule M1 is a key form in the tax return. Here you will see a reconciliation from your financial statements to taxable income. Any temporary or permanent tax differences are reported in this section. Here you'll see in Schedule M1, line 1, your net income or loss per books. This number should tie into your financial statements, if you're an accrual-based taxpayer, that is. For cash-basis taxpayers, the net income or loss per books should equal your cash-basis income. In some instances, a cash-basis taxpayer may report accrual-basis income on that line item and run any timing differences from the deferral related to the cash method of accounting through line items 2 through 7. In the example provided, the $33,000 $175 loss ties into the financial statements for this particular organization. Now, there are a number of adjustments that were made to come to the $26,355 loss reported on line 8 that essentially gets flowed through in this particular instance to the shareholders of the organization. That is the taxable income. A few examples of timing differences from book and tax purposes are depreciation or meals and entertainment. Certain expenses under IRS rules are not allowed to be deducted for tax purposes. This particular entity incurred $21,000 of meals and entertainment expenses throughout the year. These were reported in the financial statements. However, the IRS only allows 50% deduction of these amounts. So on line 3B, you can see an add back there of $10,500, meaning those amounts are not allowed to be deducted. Line 3A reports depreciation differences from book and tax purposes. There are several tax code sections that allow for accelerated methods of depreciation to be reported on the tax return. Section 179 and bonus depreciation are just 2. You may typically see a capitalized item fully expensed on tax purposes, however not expensed fully for financial statement purposes. In that instance, you would see an amount on line 6, deductions included in this return not charged against book income. In the particular example we're looking at, it just so happens that book income or book depreciation exceeded tax depreciation for this particular year. Finally, Schedule M2 just reconciles any changes in equity that occurred throughout the year. This will bring you from your balance at the beginning of the year, if you go back to Schedule L, equity, and walk through any changes in income or distributions that may have been taken to come to an ending balance at the end of the year. I did discuss a lot Schedule K1. This form is what gets generated from the Form 1120S or a partnership return, a 1065, and handed to the individual shareholder. An individual shareholder will then turn this form over to their personal tax accountant to have incorporated into their personal tax filing, Form 1040, each year. The ordinary business income loss reported in this Part 3, Item Number 1 of $18,758 is the income or loss that's generated from the entity throughout the year. There are then certain deductions and add-backs that get flowed through the Schedule K1 that may or may not be included in the entity's tax return. In this example, Part 1, Line F, shows shareholders' percentage of stock ownership to be 100%. This would be based on how many owners there are in the organization. This example, we have one owner, so 100%. Other common forms in a Form 1120S would be your depreciation schedule, or Form 4562, or your Form 4797, which is sales of business property. These two forms describe out in detail an organization's fixed asset purchases and how much they've been depreciated throughout the years. This form calculates the net book value and is what is used to determine any differences from tax and book depreciation amounts. Sale of business property is a spin-off of this form, in which it will use the tax net book value to determine any gain or loss for tax purposes resulting from the sale of any business property. I did want to go quickly over a Form 1065 so you can get an understanding of the look and feel of this return. As I mentioned, this is very similar to the Form 1120S and carries the same flow-through concept. Gross receipts and expenses from the organization are reported in the two sections as seen in the example. Your 1065 has very similar forms to your 1120 or your 1120S. Your Schedule L, which is your balance sheet, your Schedules M1 and M2, which are your differences from book and tax purposes, your Form 4562 and 4797. Again, these are just some key basic forms that you would see in a tax return. This is not by any means an all-encompassing list of forms included in tax returns. The goal here is to get the audience to understand the basics of taxes and understand the look and feel of some of the most common forms used when filing returns. Stepping away from the corporate world for a minute, most people are familiar with what a 1040 or their individual income tax return looks like. I'll briefly walk through the key numbers on this form. In the first section there, we would see on line item 7, total wages as reported on W-2. Or even before we get there, in the exemption section and filing status above, here's where you would list whether you're single, married filing jointly, or married filing separate, and then any exemptions or dependents you may be reporting on the return. For example, if you had children, they would be listed in line 6C. Moving down past W-2 wages, several other amounts could be reported on your personal tax return. In the example provided, on line 8A, there's some taxable interest, which may be the result of interest earned from savings accounts or money market accounts held in the individual's name. In some instances, there may be tax-exempt interest, as you see on line 8B, which may be the result of interest earned on certain investment vehicles that qualify as tax-exempt. Qualified dividends listed on line 9B. All these amounts would be reported to the individual in the form of a 1099 received by the investment company in which holds the funds. Line 10 is an item I typically get a lot of questions on. Taxable refunds, credits, or offsets of state and local income taxes. The amount reported here is the amount of your prior year's state income tax refund. The question I get is, well, why am I paying tax on a refund I received last year from the state? But when you think about it, the state allows for a deduction for any income taxes paid to the state. Therefore, if you take a deduction for $20,000 of income taxes paid to the state, however, you receive a refund of $10,000. so you overpaid your taxes. Well, in the prior year, you deducted 20. And so in order to make that even on the next year's return, you would pick up that $10,000 that you received as a refund as income because you got credit for it in the prior year as a deduction. Line item 13 are any capital gains or losses, which are limited to $3,000 and can only be offset to offset capital gains. Rental real estate on line 17, here is where the K1 comes into play. In this particular example, the shareholder of an organization received $296,000 worth of K1 income. Therefore, if he owned an S corporation or a partnership and it earned income, taxable income, here's where it gets reported on his 1040 return. All these items add up to on line 22 to your total amount of income. Certain adjustments take place in the bottom section, such as educator expenses or HSA deductions. In this example, you'll see there's a self-employed health insurance deduction of $12,798. The total comes to your total adjusted gross income on line 37. That gets carried over to the next page of your 1040 return where the tax is calculated. The 667 gets carried over from page 1, and then you subtract out your itemized or standard deductions as listed on line 40. Some individuals may not itemize deductions and therefore would take the standard deduction as determined by the IRS for that particular year. If your itemized deductions do not exceed the IRS determined standard deduction, then the standard deduction, the larger of the two, would be used. In this example, the individual has a number of itemized deductions which are reported on the Schedule A that they can use to offset the adjusted gross income figure of $667. Then on line 42, you back out your exemptions. So if you're married, in this particular example, there's 2 exemptions. If you had kids, they would be listed as exemptions as well, and you'd get credit. And you would back out those exemptions, $7,400 in this example, to come to your total taxable income on your personal tax return. Multiplied by your tax rate to come up with your tax due. In this particular example, there's an alternative minimum tax, which a separate form is required to be attached. That is an additional tax for income taxpayers who own over a certain amount. Some credits are deducted towards the bottom of this first section here, line 53, to come to your total tax due of $157,494. Statement 13 reports some additional taxes that may be due for this particular taxpayer. In any event, you would deduct any of the federal income tax withheld on your Form W-2 on line 62, plus minus any estimated tax payments that you may have made throughout the year. Now, this individual made estimated tax payments because they know the majority of their income was earned through non-W-2 wages. When that's the case, taxpayers are required to pay estimated tax payments to cover the estimated portion of that income throughout the year. The payments made total $318,614. When compared to the total $318,000 of payments and taxes withheld to the total tax due of $161, in this example, there's a large refund of $157,000. I'll briefly touch on the Schedule A. However, your Schedule A are your itemized deductions for any individual who's filing a 1040. As I mentioned on the first page, the deductible state taxes are reported on this schedule, which you can see in line 5. So the total state taxes paid in this particular example are $114,000, and they're able to be added into your itemized deductions and taken as a deduction against your adjusted gross income. Certain medical expenses are also itemized deductions, however, only those expenses that exceed certain threshold as defined by the IRS. Mortgage interest paid if you own a home is a pretty typical itemized deduction for your common taxpayer, would be reported in the bottom section there on line item 10. Then any donations made, gifts to charity, or unreimbursed employee expenses listed in those next 2 sections. Finally, the sum of all these items is reported as your total itemized deductions and carry forward to the second page of your individual income tax return. Other common forms you may see in a 1040 return are your interest and dividend detail, which is listed out on your Schedule B. You'll list the investment company or bank in which the income or interest was earned. Schedule D calculates capital gains and losses. Schedule C will be filled out for any self-employed individual. Schedule E, supplemental income loss schedule. For example, you may see this schedule for an individual who owns investment property. Here, the rents and expenses related to that investment property would be reported to come to a gain-loss to get carried forward to the first page of your tax return. Stepping aside for a minute from for-profit tax world, we come to the nonprofit Form 990. It's not necessarily known as a tax return. It's better known as an information return. The 990 is a key form for nonprofit organizations because it allows the organization to define itself and explain to the reader what its exempt purpose is, where the money is being spent, and it's used in soliciting donations or contributions from individuals. The 990 has a number of key schedules, and we could spend an entire presentation session going over the 990 alone. I'm going to quickly go over the look and feel of the 990, but not get into the detailed schedules too much. Page 1 of your 990 describes the organization's mission or most significant activities in Part 1, Line 1. Down below that section is where you report total revenue and expenses for a nonprofit organization, similar to like what you would see in a for-profit tax return. However, no tax is generated in the 990 information return. There are some examples in which some nonprofit organizations engage in business that may be taxable because it does not relate to its core purpose. In those instances, the nonprofit organization would file what is known as a 990T tax return, in which tax is calculated. When reading a 990, a lot of the information you need to know about the organization is listed and asked through a number of questions. If we're still looking at this first page, how many employees does the organization have? How many board members? How many of the board members are independent? These are all questions you may have when considering to contribute to a particular nonprofit organization. The 990 is a great place to go to get any information you need to know about a particular entity. There are approximately 4 to 5 pages of questions the Form 990 goes through, covering a number of items. Most importantly, governance, management, and disclosure, which I've picked out as an example here. It appears to be a lot of reading. However, every nonprofit organization must go through these questions and answer them yes or no. Typically, the answer to these questions may require an organization to explain in the form of a narrative, which would be reported on your Schedule O, or it would require the organization to fill out and complete a different schedule throughout the return. I won't go over these questions, but you can spend time coming back if you'd like to read over some of them to get an idea of some of the questions nonprofit organizations are required to report. Getting back to the numbers a little bit, nonprofit organizations are required to show in a statement of revenue where its sources of revenue from, and on the next slide, which we'll get to in a minute, where are its expenses. Very similar to the set of financial statements, nonprofits would report the information in these forms. Now, it's key to note that not all nonprofits are required to file a Form 990. The IRS has certain threshold limits that may require a nonprofit organization to obtain an audited financial statement or a reviewed financial statement, and then in turn report and file a 990, or the Massachusetts version, which is known as the Form PC. Threshold amounts for nonprofit organizations to file an audited financial statement and a 990 are $500,000. Here on the statement of revenue, you can see that the particular nonprofit organization does not receive a significant amount of contributions or grants as would be reported in that top section. Any fundraising events held by a nonprofit organization would also be reported on Section 1. You can read through in detail here. However, the total revenue number reported on line 12 is what gets carried forward and what should tie to your financial statements. Now, very similar to a for-profit organization, a nonprofit may have book and tax differences. Certain nonprofit organizations may be required to report unrealized gains or losses as an other change in net assets for financial statement purposes, but for tax return purposes, they may be reported as income. Certain in-kind goods may be reported on your tax return in the Schedule D, which is your reconciliation to the financial statements, but not reported in the Schedule of Revenue. In-kind goods would be reported as revenue in a basic set of financial statements. So those are some differences that you may see on the revenue side between book and tax purposes. And again, once you get past the core schedule and into the individual schedules, Schedules A through I, Schedule D is the schedule that reconciles your book and tax differences. A lot of focus is spent on this next schedule, on the next slide, which is your statement of functional expenses. And most nonprofit organizations want to have the majority of their expenses be attributed to their program service. As you can see, the expenses are split out by program service, column B, management in general, column C, and fundraising expenses, column D. As a donor, you may come to this schedule to make the determination as to whether or not you feel the nonprofit organization is prudent in spending and it's spending the money in the right place. Column B, program service expenses, should be the largest bucket of the three. Depending on the industry, program service expenses could be anywhere between 70% and 90%. Part 10, which is the balance sheet, is going to be very similar to a balance sheet on a nonprofit financial statement, and also very similar to the for-profit, partnership, and 1120 tax returns that we looked at. Schedule D, which I made reference to a few slides ago, reconciles your revenue per the audited financial statements and the tax return. In this particular example, parts 12 and parts 13 have no numbers filled in. They just so happen to be no differences. Up top, on part 11, there's a reconciliation of the change in net assets from the financial statements to the 990. Here you can see on line 4, unrealized gains or losses would be reported. In this particular example, there are none. One of the most pertinent schedules in the 990 is the Schedule J. Schedule J reports compensation for officers, directors, key employees. It's a very sensitive area on the Form 990, and it's one area that's scrutinized often. 990s, as you may know, are public returns and can be pulled off the Attorney General's website for any nonprofit organization. One thing to keep in mind when reviewing the Schedule J, compensation as reported on this schedule is required to be on a calendar year despite what your fiscal year end may be. For example, if your fiscal year ends September 30th, 2013, the compensation reported on the Schedule J would be for the previous calendar year, December 31st, 2012. In the Schedule J, you will see several columns reporting different amounts of compensation. Here in Part 7, you will see this information flows forward to your Schedule J. Here is where you would list the individual officers and directors, their reportable compensation in Schedule D, or any amounts paid to these individuals from any related organizations in Column E. Column C is where you would check off what their actual position is. In this particular example, the names are blocked out. However, you can see the first 4 items are board members who are not compensated. The next individual is an officer, then a key employee, and then the bottom 3 are the highest paid, the next 5 highest paid individuals. Some other key schedules in the Form 990 would be the Schedule R, related organizations, Schedule L, interested persons, Schedule B, list of contributors. Now, I won't go over these individual detailed schedules. However, it should be noted that when reviewing the first 4 pages of the individual 990, you may see a certain question answered yes, which would require the completion of one of the schedules just mentioned. I know we didn't get into detail on the Form 990 schedules. However, we can spend a significant amount of time reviewing that information. If there are any further questions on the Form 990 or its schedules, or any of the other information listed throughout this presentation, please feel free to call us at 617-742-7788 or go to our website at www.fdcpa.com. I'd like to thank everybody for taking the time to listen to our podcast today. and we hope you have a better understanding of the look and feel of some basic tax returns and understand some of the key concepts and where some of the figures come from. Thank you.